I remember Jim.
Hey, Dale, you got me now?
Oh,
got
you,
Jim. Yes. Hi. Where
Sorry,
were you? You out
I
in
don't
the
know.
VIX jungle?
Technical difficulties.
Okay, buddy. Well,
Always
Jim,
something.
you should have grabbed like your kids and brought them in. They usually can fit. I'm like, I got a technical issue. I go grab my teenagers.
Yeah, my kids are a little older than yours, Blake. They're
go grab your grandkids then. Just kidding.
still waiting on those.
Yeah.
Good.
There
Good
you
for
go.
you. Good for you.
Yeah,
Hey,
and you said
thanks for joining us, Jim.
Patience pays, Jim, and so you're going to have to be patient with me. I don't know if you're going to share your screen or not. Are you?
I have some things to share if that works for you.
Okay, that's fine. That's on the bottom, the
Yep.
green button. So I know you've probably heard this ad nauseum for months. Why isn't the VIX at 50, 60 with this severe bear market decline that we've had in equities?
Okay, let me try to address that. Are you seeing my screen
Not
right
yet.
now?
No, you
Okay,
click
so
the
hang
share
on.
screen.
Yeah.
And then then it says share.
Right.
And then it should come up.
Yeah, hang on one second. Okay. Let's go here. Let's go share.
Okay.
And then let's go here. Yeah.
All right. Yeah. What the hell is wrong with the VIX? I like it. All right. That's what everyone's saying, especially people who bought VIX calls.
Yeah, it's broken.
Yeah. Is it broken?
Well, not really, but let's walk through a few things.
Okay.
So, what's driving everybody crazy is that, for the last month and a half, we've been printing new lows. We had a little bounce, at the end of May.
Yes.
But, VIX doesn't seem to want to budge. And here what I'm showing is VIX in the bottom, right? And we haven't been able to break out above that 35 level, which is what people were expecting as some sign of the capitulation. And, the middle panel is showing the ratios of the different SIBO tenors of volatility, right? Because SIBO's got a 9-day, a 30-day, a 3-month, and a 6-month, and a 1-year even now. And you can see particularly the blue and the green line, which are the VIX to the VIX 3-month and 3-month to 6-month, just refuse to get above that one line, which would suggest that, things are really in backwardation using that term structure. And we're just not there. So why are we not there? Well, one of the reasons we're not there is because, a line that goes from lower left to upper right, a straight line that goes from lower left to upper right is what we're all seeking in our investment returns, and that has zero volatility. If you look at the decline, particularly from April to mid-May, it was pretty much a straight line going the wrong direction. But, again, that's relatively low volatility. People were referring to this decline in the S&P as a grind lower. And, that's been a fair characterization.
It was orderly.
Orderly, exactly. Yeah. And so orderly declines just don't tend to provoke, big spikes in volatility. The other thing that's happened, though, is if you take a look again using SIBOs, and I like to use these because they're constant maturity, right? If you look at the VIX futures, the maturity of each of the contracts is changing every day, right? And so, I like to use these to get a gauge. And if I look at, the trailing 12-month average for these guys, there's a nice contango shape to that term structure where, at yesterday's close, not only was it elevated and relatively flat, but we also had 9-day, as an outlier up there, because everybody's still nervous about, today's options expiration and, what might happen over a long weekend and all that stuff. But, we have to remember that a 34 VIX, the shorthand is to divide that by 16, and that implies daily moves of 2+%, which on average is kind of what we've been getting, right?
Exactly.
So why should VIX be any higher? The answer is there's no particularly good reason for it to be higher than it is right now. And, everybody wants to see that capitulation spike. Well, guess what? I guess we haven't capitulated yet. Now, does
or
it
we're
mean
not going to have one, and that's how everyone misses the bottom of the market.
bingo?
Because they're waiting for that. Is that what you think, Ben?
Well, I wouldn't let's put it this way, Dale. I have no clue, but
yeah, me either.
I wouldn't be surprised.
I guess,
Yeah, we all guessed. So again,
it's fun to guess.
Yeah, well, you look,
Until
we're
you
all
put money on it.
exactly. We're all once you put money on it, you're making a prediction.
Yeah.
And you may not view yourself as somebody who makes predictions, but implicitly you're making a prediction.
Right.
And by the way, I try to keep any of my predictions to myself to avoid looking dumber than I am. But we all have to recognize that that's the business that we're in.
Right.
Some people are more humble than others. Looking at the VIX futures term structure, again, what you see is that we're elevated. I'm sorry, the green is a little bit faint.
We see it.
But we're elevated. We're incredibly flat over the term structure. And so again, we're at high levels of implied volatility right now. No particular reason at the moment that we need to be any higher.
Okay.
Here's another way to look at what's been happening with the term structure. And there are a lot of squiggly lines on this chart, but what it's showing is, again, going back to the SIBO volatility measures, the standard everything's okay array would be for 6-month volatility be greater than 3-month, greater than 30-day, greater than 9-day. And, what we're seeing is compression in the range of those indicators. And that means the term structure is flattening, which we saw on the prior slide. But at the same time, it's not moving higher. It's just squeezing into a narrower space at an elevated level.
What could be the catalyst for a breakout over 35?
That's a really good question. But it's going to take, a sharp move, and it's going to take something that is a bit of a surprise. People would have said that 75 basis points from the Fed on Wednesday would have been a surprise, except that they leaked it to the Wall Street Journal. Had they gone a full 100 basis points, that would have been a different animal and could have caused a breakout in volatility. But we need something that truly is a surprise to the markets. And what would that be?
You mean like Putin using a tactical nuke in Ukraine?
Putin using a tactical nuke in Ukraine might do it. Some breakout in some geopolitical event. Food shortages causing riots in wherever.
Everywhere.
There are a bunch of things that we can imagine.
Because when you look at this formation, it actually, it's bullish. It hasn't broken out yet, but it's an ascending triangle. You have the bottom uptrending and a flat top. And that's you go to Edwards and McGee, that's a classic reversal formation, an ascending triangle that portends, doesn't guarantee it, and you never know when,
right? But
actually gives the odds of a breakout to the upside eventually, that it looks like that could happen.
It certainly does look like that. And, again, when the term structure, whether you're looking at the VIX futures or you're looking at the SIBO indices, when the term structure flattens the way it is, particularly at a fairly high level, that flat suggests indecisive, right? We're pricing today's volatility the same as we're pricing volatility a year from now. And that in normal markets doesn't make sense. You would pay more for insurance a year from now than you would 9 days from now. And so we need something to flip that term structure back to its more normal state. And that's just not going to happen easily.
Do yields come into play at all
I'll get there.
Oh, okay.
Certainly the bond market does, and I'm going to come to two things that I keep an eye on as some indication of what's happening in the bond market, because I do think intermarket relationships go back to Murphy, right?
Yeah.
Whether it's looking at currencies the way you guys do on a daily basis, commodities, it's important to look across assets and figure out what they're suggesting about equities or whatever it is you choose to trade.
Because
Anyway.
bonds did not work as a safe haven either. In fact, they led the decline in equities.
Bonds have been horrible.
Yeah.
And that has caused, a lot of, I think, just talking to my own clients, talking to other advisors, the fact that bonds have failed as a diversifier has created a lot of problems, among investors for whom that 70-30, 60-40, has been a bedrock of stability.
Yeah. A lot of 401ks are.
So here are a couple of examples of, things that aren't working that are volatility related.
Okay.
The CBOE has this P-put index that they publish, where you own the S&P 500 and you own a 5% out of the money put, right? So market down, put should go up. But as you see here, again, that steady grind lower, that premium that you're paying for the put, you're not collecting anything to speak of on that put. Maybe it's offsetting, the cost of the put, but it certainly isn't giving you any bang for your buck, since the P-put index has basically just tracked the S&P 500 year to date. So put protection has been, a loser. Again, just using this particular index as a gauge. So what about, VIX calls? Well, CBOE's got an index for that too, the CBOE VIX tail hedge. And so that is buying out of the money calls on the VIX as a way to hedge your tail. And, it seems to me that down 21% in the S&P, might be viewed as a tail event by the average investor. But once again, that the premium paid for those calls, because of where we are with implied volatility, hedging has been expensive, and it just hasn't paid off because we haven't had the outlier event, the convexity event, to cause those S&P puts or VIX calls to really pay off. And it's been very frustrating for people, but it's the nature of this grind down, a little bit of an uptick, grind down some more, market that we've been in year to date.
Yeah, I guess the guy's doing strangles, just writing calls on every VIX rally and writing puts on every VIX decline. It probably has been working hugely instead of directional. So what are people doing? They shorting volatility?
Well, shorting volatility has not worked that well either. Again, because we've had these whipsaws, you get your face ripped off when the S&P turns around and rallies 5 or 10%, and then you try to short it again. The other thing is, when do people prefer to put on short vol trades? They prefer to put short vol trades on after the VIX has spiked, to a measured level. And again, we really just haven't seen that reliably year to date. VIX has just gotten into the 30s and stayed in the 30s. We've had a couple of circumstances where shorting that, would have been okay. But you also have to be much more nimble. I was having a conversation with an advisor that I know the other day, and we were talking about how we're approaching the market, and he tends to be fairly active, as do I, and we agreed that one of the challenges in a market like this is that you have to shrink your time frame. If you were putting on trades for months and years,
Now it's days.
You're down to weeks and days.
Okay, yeah.
This is a day trader, swing trader market, in my opinion. And oh, by the way, who does that? Not very many people. Certainly there are a very small number of advisors who are comfortable being that tactical.
Right.
Your average investor has no idea what that even means to be a swing trader. So I think this is a market where professional day traders and swing traders have been able to make money, and it's been a complete nightmare for most of the rest of people.
Okay. And
you said during the first half hour, one of the things you said was it's hard to have conviction.
Yeah.
And I couldn't agree with that more. I think you need to throw conviction out the window for the moment, and take what the market is offering on relatively short time frames. And if you're not comfortable with that, then I think you need to,
be out of the market. Boy, that's an option, isn't it?
It is an option. And, I run some short-term momentum models that are out of the market. Now, people say, well, how can you put money in cash, with inflation at 8%? Well, if I'm losing 8% a year and the S&P is down 20%,
yeah,
it's
a lesser of two evils.
Lesser of two evils. And I think we are also in a lesser of two evils market right now.
Okay, Jim.
Let me keep moving.
Go ahead.
So this is a chart that shows the performance on the top. It shows the performance of the S&P, right?
Yeah.
And it shows the performance of an ETF that is designed to hedge. So again, what we're seeing is the hedges just aren't really paying off to any extent. And the bottom panel shows 4 ETFs, 2 of which are, long short or short biased,
like
ETFs. Well, yeah, except that these are managed,
okay.
Short biased.
Okay.
One is HDGE, which is Ranger, and then there's a Dorsey Wright short ETF, long short ETF. And no surprise, those have done really well in the last couple of months. Where if you're really just looking at hedges, tail, right, is designed to be a tail hedge. CYA is again designed to be a tail hedge, and year to date, you just haven't gotten any real payoff from those, right? If you had taken your S&P portfolio and said, I'm going to give 80% to the S&P and 20% to one of these things, or some mixture like that, it hasn't added any value. You're down basically the same amount as you would be if you were just
you hadn't have done it.
Yeah, so the tail hedges just haven't worked.
Okay.
Bonds. Okay.
That's where it's been. Yeah.
Yeah. So, what we've seen is a big surge in bond volatility measured by the MOVE index, which, a lot of people say, well, it's not that great. Well, it's kind of what we have. It's a reasonably well constructed measure of bond market volatility. And what's plain as day is that there's been more volatility in the bond market and in bond yields than there has been, in the equity market. So, that's been a big source of market vol.
Okay. And so, I've heard people talk, there's a huge gap between, and you're showing it.
And if you listen to the guy who cooked this up when he was at Merrill Lynch a bunch of years ago, is a guy named Harley Bassman, who is the convexity maven on Twitter, has a blog, and is also involved with a company called Simplify ETFs. And Harley sort of downplays, this spread between the MOVE index and the VIX index. It's not like the VIX index has to catch up with the MOVE index. It could, but from his perspective,
go the other way.
Yeah, from his perspective, he doesn't put too much credence into big gaps between the two.
Like a mean regression.
Right.
Yeah.
He doesn't want to take people there because he doesn't think it's anchored in, how they really work.
Do people short bond volatility, the MOVE index? Is there a way for them?
The MOVE index.
Yeah,
the MOVE index, like the VIX, is not investable.
Okay.
So there certainly are ways that people can take a view on bond volatility. It's not my particular area of expertise.
Okay.
And I think that, you can certainly short rates, or
you could just buy bonds.
Yeah, there are any number of trades you could put on to express a view that bond volatility has gotten out of hand and needs to come down. But the index itself is not investable.
Okay.
So Dale, let me finish with a couple of things that I'm keeping an eye on. One of which is I keep track of 52-week highs and lows, and then I net them out, so it's new highs minus new lows, and then I sort of smooth that out by taking a 5-day cum. And what you see on this is that that new high, new low broke through the zero line back, late last year.
Yeah.
And has struggled to get back above it anytime this year. Minus 4,000 is sort of the depths of despair. And, we just broke down below that again. So, one of the things I'm keeping an eye on is some relief from this measure of market breadth, to give a clue as to, how equities might behave. We need this to reverse. Bulls need this to reverse. Bears are happy as clams, with this down where it is, and happy to have it go lower.
Yeah, they'd like to see it revisit the COVID low.
Yeah, sure, why not?
Take it down to minus 11,000.
And it's possible that we could get there. And one of the things that's interesting about here, I don't have it on this chart. Let me see if I can find it. But if you go back to the COVID lows, this actually turned around and was heading back up when the market made its March 23rd low. So, it had,
it led.
It led. And nice. So, we'll see what happens going forward. I have no idea, but it's one of the things that I watch on a daily basis. One other thing that I keep an eye on, and it's not terribly bullish right now, is a measure that Tom McClellan came up with, the McClellan oscillator.
Right.
If you're familiar with some of the work that he's done. And there's data that's available that shows, for the high yield market, advances and declines in high yield bonds. And what he figured out a while ago was that if you could keep an eye on that cumulative advance decline line for high yield bonds, it might give you some clues. And, going back, you could see in 2015, 2018, where, again, weakness in the high yield market as reflected by advanced declines gave you a heads up that there might be some weakness in the equity markets. That the pandemic sort of came as a surprise to everybody.
Right.
But now, we're in this phase where high yield AD rolled over before the equity market really did. And you can see a couple of little bounces in here in that red line, but they're little bounces and followed by resumption of the downtrend. So, this is another one. This is one of those, intermarket indicators where the high yield bond market may be giving us some sense of what to expect or what to be concerned about with the equity markets. And
do you watch the spread between treasuries and high yield as well?
I sure do. And, one of the things that we haven't yet seen is that spread blowout. Certainly spreads have widened and yields have risen by virtue of the underlying treasuries going up in yield and the spreads widening. But we haven't seen, a blowout in terms of spreads at this point. A lot of people are watching for that. If we do get that blowout, it's not, again, it's sort of like this chart. It would probably not be good news for the equity market.
Yeah.
And it's definitely something that people should be paying attention to.
Really appreciate you sharing your models and some of the things that you pay attention to, Jim. Great presentation on what's happening with volatility. You're definitely the guy to talk to about all of this going on and all the questions people have about underperforming. And I did notice a tweet that you said, patience pays. And I think that is an implication that you think eventually we will break out over 35.
I come from the school that says nobody knows.
Yes.
But I also come from the school that says, if you pay attention carefully to whatever market you're trying to trade, my experience is that there are some breadcrumbs. I think the reality is that most people, even a lot of professional investors, aren't really paying careful attention. They got other things. They got wife, kids.
Yeah.
And
they're not interested in breadcrumbs anyway after the most prolific bull market in history over the last 20 years.
Buy the dip.
Crumbs.
Buy the dip. Well, and what I'm really saying is that there are clues for people who really kind of want to put the work in and pay attention. That's my belief, and it has served me reasonably well. And so I encourage people to broaden their scope of vision and start paying attention to things that might help them manage their portfolios and preserve and grow their capital.
Jim Carroll saying, pay attention to the clues, and thanks for cluing us in, Jim. Thank you, my trading warrior brother. Really for a great interview. I'm going to watch it again because there were some points I need to hear again. Appreciate you being here and look forward to the next time we get together.
Always my pleasure, Dale.
Yeah, so you could find Jim on Twitter at VIXologist and also at Taroso. So follow Jim, and he's fairly active on Twitter, and you'll know what he's thinking. And
I'm active on Twitter, and people can send me direct messages, and as long as it's friendly and polite, I will respond.
There you go. Civility on Twitter. Jim's asking for a breakout in the VIX. So they're both as likely. So anyway, Jim, thanks so much, buddy.
You're welcome.
You have a great trading summer, and look forward to talking to you again in the fall.
Excellent. Thank you.
All right, everyone. That's Jim Carroll. Hope everyone had a good week. We've done our best to provide, risk management ideas, some actionable ideas, and hope you guys have had a decent week. Feels like a month this week to me. So know what you're going to do next week and figure that out on your kitchen table over the weekend. You could join the team in 10 minutes for the morning edge. And remember, most of all, don't just count your pips, count your blessings. Adios. Thanks again, Jim Carroll. You're welcome, Mary.
Thanks, Dale.
You're welcome, Jim. You're welcome, Sinatra. See you guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.